Hello, all. A very good evening to all the attendees who have joined us today. Welcome to the webinar series of Advait. I'm Srilata, a chartered accountant and working with Advait in the team of knowledge and solutions. And I have with me CA Krishna Upadhyay sir, co-founder of Advait iTech Private Limited. Welcome, sir, for today's session.
Thank you, Srilata. Good evening to everyone.
Yes. So we are now at the third and final session of this ESOP series. And over the last two sessions, we had built the foundational understanding of ESOPs and explored them from the employee standpoint. That was basically looking at how equity participation is experienced and how should it be looked at from an individual level. If you had missed watching it on live, you can watch the recorded one on our YouTube channel where we have streamed it. In today's session, we shift the focus to the employer lens to understand how organizations approach equity participation from plan design and financial reporting considerations, governance aspects to cross-border impacts. From an intent and concept angle, we had discussed in our initial session on foundational aspects of ESOP mechanism. However, to look at it purely from employer's angle, ESOP conversations ideally should not begin with accounting frameworks or compliance requirements or regulatory aspects for that matter. They should ideally begin with purpose. Organizations adopt equity participation for different reasons. It depends on their growth stage. Like for some, the objective could be building commitments. For some, it becomes mechanism to retain critical talent where continuity is important. And for others, especially in a larger organizations or established organizations, equity plans often evolve into long-term incentive structures. And over the time, if you see, these plans ultimately contribute towards fostering a sense of ownership where employees see themselves as participants in organizations' value journey than just looking at purely from employer-employee relationship. And if you see, ESOPs may not always be the sole or single suitable instrument in every situation. It depends on promoters' objectives, dilution expectations, cash flow considerations, and based on all these things, organizations sometimes look for alternative instruments as well. For example, let's take a few examples like SARs or stock appreciation rights. Here, employees receive the appreciation in share value over a defined period without actually owning any shares. So there is no dilution aspect coming into picture here. This helps to share company's growth and motivate employees. But of course, it results in cash outflow for the company at the time of settlement. Then you have RSUs or restricted stock units. Here, shares are granted upon fulfillment of vesting conditions without requiring employees to pay an exercise price. And these are often used in matured or listed environments. Next, we have ESPPs or employee stock purchase plans. What happens here is employees are allowed to purchase shares, typically at a concessional price, and generally it encourages wider employee participation in ownership. And if you compare this with ESOP, these plans generally do not involve structured stages like granting, vesting periods, exercise periods, etc. But of course, they operate through a defined purchase window during which employee can acquire using their own funds. So this is about ESPPs. And then we have other cash settled plans where it involves granting employees notional units linked to share value and alternatives and where no, in such cases, no shares are issued, but the company pays out cash equivalent to the share value at a future date. These different instruments serve different purposes. So therefore, the choice between ESOPs and alternatives is not a standard practice to adopt. It becomes a strategic decision when you look at it from employer perspective. And another critical aspect of when you have to see from employer standpoint is governance and policy framing. The entire effectiveness of how an ESOP or any other instrument for that matter is depending upon how effectively the policy has clarity, or how effectively the policy is designed. The policy should be clear on eligibility, the grand philosophy with which employer is issuing it, the vesting logic, treatment upon resignation and termination. This is going to be very critical, and handling exceptional events such as restructuring or exits. And lots of operational challenges arise later because of generically drafted policies without anticipating the future incidents. Hence, a well framed policy, a well designed policy is critical to ensure consistency in decision making and to reduce future interpretational challenges. With this background and context, sir, I would want you to pitch in to add further insight on how employers should approach ESOP design and intent, and where organizations tend to complicate this entire framework.
Okay. So, two, three things typically happen. When a startup gets formed, the founders are looking for fantastic team to join them, great performers to join them. And sometimes what happens is that they overdo promises in terms of what they can give to their potential employees. While at that time, the survival instinct kicks in for the founder, and therefore they will be wanting to promise ESOPs which are significant in number, significant in value in the future, etc. And they will not think that, as the journey of a company goes forward, there are multiple such great performers, founder kind of thinkers have to come in into the system. So, in the beginning of times when you are designing a particular ESOP policy, one, don't make it generic. Don't borrow from one of your friends who was also a founder. Somebody drafted an ESOP policy for them, therefore you adopted from it. You asked a GPT tool, it gave a ESOP policy, go ahead and adopt it. Don't do that. These are some very common mistakes that people do, because while GPT can give a fantastic format, but then it doesn't align with every nook and corner of what you want to do. It might not tell you the blind spots that you will be thinking at that point in time. You may be doing starting a business which has a fabulous future, and the valuation it can reach and the journeys it can charter is substantially large. In such situations, a mistake that is done in an ESOP policy drafting and overdoing by a founder to grant stock options to employees without really understanding the impact of it from a financial and governance standpoints could actually be catastrophic. There are situations that we have seen where cap tables have gotten completely destroyed by the time the company has raised its second or third round of funding, because the founders would have become a small minority, investors would have become a substantial majority, and the second majority would be ESOPs. Now, these are situations which are really troublesome, because in such situations, the investor tend to one start driving the way decisions are made, because ESOP is a pool of multiple people, right? So it need not go in a certain sequence. However, founders may have a certain vision. They can't force that vision anymore, or forget forcing it. They can't even put across that vision anymore, because they don't hold majority stakes at all. One situation. Second situation, there are companies which are small. In the beginning, they gave out ESOPs to people who they thought are going to continue quite well long in the company, and the company took a larger gestation period, and by the time the gestation completed, some of these early stock option holders have quit the company, but your policy doesn't allow you to buy back those shares, or the liquidity can only be given through a investor induced exit or an IPO induced exit. Therefore, what happens is that they become a significant shareholder in your company, and then such employees are no more part of your company at all, even as employees. These are some things that one has to be very careful of. Such pitfalls should be avoided. Consult a great consultant, advisor who can really help you navigate all of these challenges, can help you think through 3, 5, 7, 10 years down the lane if things go well, 3, 5, 7 years down the lane if things don't go well. Try and cover as many situations as possible. I don't say anything can be done perfectly. Try and make it as near perfect as possible in such circumstances. So these are some things that one has to keep in mind while designing a ESOP as an employer.
Thank you, sir. So we have been talking about the intent, designing, and structuring aspects, which should be, of course, the initial point. Let's move on and see how ESOPs start impacting financial statements. So let's look at the accounting framework within which how ESOP functions. The accounting impact for an employer does not arise when employees exercise the options and or purchase the price or when the shares are allotted to them. It actually begins much earlier from the grant stage itself throughout the vesting period. The expense is recognized progressively during ESOP phases, and it has an ongoing impact on profitability even without any cash outflow from companies or organizations end. From accounting framework standpoint in India, companies broadly follow either the ICAI specific guidance note on share-based payments, ideally for IGAP applicable entities, or Ind AS 102 share-based payments for Ind AS applicable entities. While both are for ensuring proper recognition of employee compensation, their approach to measurement differs significantly. Would like to highlight 2 points in this perspective. Firstly, under the IGAP, companies are permitted to use intrinsic value method. It means the expense will be calculated based on the difference between market price and exercise price. But under the Ind AS framework, what happens is companies are required to use the fair value method. And under this, the option valuation models typically cover not just the difference between the current market prices, but they will also have to consider time value and future expectations. Hence, it could result in higher recognized expense over the period of time. And one more the second critical distinction that I would like to talk about is in case of forfeiture or lapse of options. Under IGAP, adjustments generally happen when options actually lapse, leading to a reversal of expense at that particular stage. But under Ind AS framework, companies are required to estimate expected forfeitures upfront and continuously revise those estimates during the vesting period. This can be understood or termed as a true-up approach on continuous basis. This means the recognized expense keeps getting adjusted based on employee attrition expectation that the company has. And lastly, from a disclosure perspective, both IGAP and Ind AS broadly require transparency around ESOP movements along with valuation basis and assumption used. So if you see the intent under both the framework is largely investor transparency and making sure that we enable the stakeholders to understand the potential dilution and compensation impact that gets arise from equity-based plans. So while these measurement approaches or the assumptions that both the frameworks carry differ, disclosure expectations are largely aligned and overall intent is largely the same under both. So would you like to add any insights with respect to these points and also considering the practical challenges that are there for employers in implementing and ensuring these compliance?
Yeah. So, from a founder standpoint, one would start thinking as to, hey, look, I'm issuing shares, that too in a future date, based on a grant condition, a vesting condition that I have fixed why would I have to recognize an expense on a year-on-year basis is a typical conversation that we always start with where we are advising our companies. So in most of the situations, you will have to understand, or rather, let me put it this way. Now, what are you doing? You're essentially telling a particular employee that, look, you are rendering services to me today, employment services to me today for the company. I can't pay you your salary in full at this point in time, because what impact you can create through your employment, through your services to the company could be substantially higher, which will get a return on a future date. Given that, I am going to reward you by way of partially money, which I can afford today, and partially in the form of shares or in the form of appreciation in the value of shares, which may get appreciated in the future. But one needs to understand that the services are actually rendered today, are rendered continuously by those employees to the company. Therefore, the accounting norm requires that one, you will have to recognize the cost of that service in your profit and loss account, statement of profit and loss every year, as and when the services are rendered, and you'll have to make a provision for that entire cost continuously. Now, the question comes, at what value do we recognize? See, valuation is a slightly complicated subject. Like Srilata mentioned, in IGAP, the Indian GAAP has a different method to do it. The Ind AS has a different method to do it. You will have to make sure that you recognize the costs correctly and the valuation is taken care of at right points in time by the right experts. Now, what will this do is that the profit and loss account will be notionally brought down, even though your cash is not getting paid out for this particular item of expenditure that you incur. Therefore, while making promises to the board, to the investors, it is very important that the CFOs of companies, the finance heads of the companies, or the founders do realize the fact that this cost of ESOPs or ESPPs or whatever the different forms of instruments are there could be significantly high sometimes. Therefore, you might have also seen some of the companies, startups particularly, which are on the path to listing, typically give out an EBITDA and then carve out or call out the employee stock option costs separately and call it as adjusted EBITDA and things like this. But one thing is clear, these costs have to be accrued on a regular basis based on the services period that the employee renders those services to the company, and then the cost has to be recognized on a true and fair basis based on the accounting norms. There is no postponing that is allowed, and such postponement, if carried out, could lead into qualifications by the auditors, because those will not be in compliance with the IGAP or the Ind AS. Therefore, you will have to make sure that whenever a particular ESOP plan is conceptualized and you're planning to give out stock options to employees, you'll also have to understand its financial impact from a P&L standpoint, financial impact from how does it get disclosed in a balance sheet standpoint. Jumping into it without understanding this could become very detrimental to the interest of the company's financial statements. So have a great accounting advisor on your side while making this decision.
Yeah. Thank you, sir. So this is all about accounting framework within which ESOP functions. But if you see, ESOP implementation does not always remain confined within a single jurisdiction. They operate across jurisdictions, especially in group structures where either a foreign parent grants equity to employees in India, or an Indian company where whenever they have employees located overseas, they might participate in equity plans of Indian entities. In these scenarios, one of the key clarities that organizations need to have at the structuring stage itself is who is actually bearing the ESOP cost, whether the grant is being made directly by the parent company or is it routed through subsidiary, or is it handled through a separate ESOP trust? That needs to be determined at the beginning stage itself. Uh, it becomes critical because accounting recognition, intercompany arrangements, and compliance obligations entirely depends upon these aspects, because they follow the economic substance of who ultimately receives employee services and who ultimately absorbs the cost. If you see from a governance and regulatory standpoint, the ESOP scheme may be approved at the parent company level under a global plan, but a local board acknowledgement or approvals are required to enable the participation of employees in that particular jurisdiction. In addition, cross-border grants need to be viewed in the context of FEMA regulations, particularly the non-debt instrument rules, along with potential transfer pricing considerations where costs are recharged between the entities. With this brief overview, I would like to hand this over to Sir for taking us through FEMA, TP, and employer obligations to make sure that the compliance is in place, even from taxation point of view. Over
Right.
to you.
Now, while we spoke about the accounting in our previous section of conversation, now coming to the taxation side of it, now the immediate first obligation is that for an employee, whenever there is a grant that happens, there is no taxation. When the vesting period is ongoing, there is no taxation. However, when an exercise takes place, there is a taxation that is involved. For startups which are recognized by Government of India, DPIIT, there is a postponement of taxation that is also prescribed under the tax laws in India. Now, for non-startups, whatever is the value of the stocks that are given out on the exercise event, there is a tax that is involved, and that will be treated as a part of salary, and withholding tax or TDS on that has to be deducted. This is one of the first tax obligations that a employer has. Moving further, like Srilata was mentioning, following possibilities can happen. There could be an Indian multinational, that is a company which is headquartered in India, has subsidiaries outside India. Then the Indian headquarters or the parent entity will be giving out or bringing out an ESOP scheme for all its employees globally. Typical companies like Infosys, TCS, etc., Tech Mahindra, which has subsidiaries around the world, gives out its stocks of its Indian listed entities in most of these cases to employees worldwide. Now, like we discussed in our previous section, during the entire course of the life cycle of the ESOP itself, accounting needs to happen where cost is booked in the P&L. Now, the question is, who will bear this cost? Like Srilata said, though the shares that are being given out are that of the parent company, the real cost is of the subsidiary in cases where these shares are given to the employees of the subsidiary. Therefore, a right kind of employee stock reimbursement agreements have to be signed off between the Indian parent and the subsidiaries outside India. Let's now inverse the situation. Let's say there is an Indian subsidiary of a foreign multinational, a multinational which is headquartered in the US, in the UK, or Singapore, or anywhere. Let's assume the parent entity is bringing out stock option schemes whereby the Indian subsidiaries employees are also eligible to participate in this. One, the company law in India allows this to be done. There is no restriction on this. Second, like Srilata said, there are considerations on foreign exchange control regulations in India which needs to be dealt with, particularly the non-debt investment rules, and a suitable documentation to make sure that this cost is actually borne and recorded in the books of the Indian company has to be done. That is exactly what I referred to earlier as a stock compensation reimbursement agreements. These agreements become critical from a tax standpoint, from a foreign control regulation standpoint, to ensure that you record these costs and the auditors are satisfied about how this recording is happening, and of course also to make sure that your transfer pricing is taken care of correctly, because Let's take scenarios of captive service providers, that is, Indian subsidiaries which are providing its entire services to its parent entities outside India. In such situations, the cost of these stock options granted by parent entity is also the cost of the Indian entity. And the question arises whether, if I am doing a cost plus markup basis of billing, should I take this as a cost or not? If I take, what is the kind of documentation I need to have? If I don't take, is that justifiable? There are innumerable judicial precedents on this in India. Tribunals and high courts in India have detailed out as to how these are going to happen. So, a word of caution to finance teams of either Indian multinationals or Indian subsidiaries of foreign multinationals, or the heads of units of Indian subsidiaries of foreign multinationals. Don't just think that because the stock options are given outside India, you don't have an obligation in India. By not doing anything, you may be violating multiple law, and you may be violating the tax laws. Your financials are not disclosing the right cost, your transfer pricing may be at a risk, and so on and so forth. So therefore you have to keep into consideration all of these and ensure that the compliances are made. Lastly, a very important thing, uh, there's a very popular judgment that occurred in the case of Flipkart, whereby there was a compensation that was given out to the employees of Flipkart who were holding stock options of Flipkart. And when the PhonePe demerger happened, the value of the Flipkart shares came down, and then therefore the board of Flipkart decided to give certain compensation. The question was whether, how is the taxation on this? Is this considered as salaries and therefore withholding tax has to be applied by the employer, or are these considered as capital gains in the hands of the employee because they are surrendering some right and getting something? There was a very critical judgment that came out from the court in India on this. So that also needs to be considered and dealt with in detail. Of course, these are all fact specific matters. There can't be a straightjacket simple answer given to this, and that's not even the objective of our webinar series that we are doing. Our webinar series is more aimed at ensuring that you have those checkpoints that are available with you before you make a jump into taking a certain decision, and you are alerted to contact the right kind of experts at the right points in time before jumping into that. So therefore, in both scenarios of an inbound receipt of stock option or based on an outbound stock option that an Indian multinational gives out, there could be multiple tax and regulatory consideration that one should take care of.
Thank you, sir. So with these discussions in today's session, covering various aspects, considering design framework, accounting framework, and cross-border considerations, and of course, with our previous two webinars, which covered conceptual and foundational aspects, followed by seeing ESOPs entirely from employees' lens, we can see that this entire framework, ESOP, it acts as a bridge between individual wealth creation and organizational value creation. While employees experience or see this as an opportunity and wealth creation, for employers, there is a lot more to do. They are responsible for designing it thoughtfully and making sure that the required compliances are adhered to. So we can term from employees chapter, which is the today's headline of this particular webinar session. We can term this as ownership engineering from an employee perspective. And ultimately, the overall success of ESOPs uh, is when the value creation, when the governance and long-term alignment, everything happens together in a sustainable manner. With this, we have come to the end of this webinar session and the series on ESOPs. We hope this session and the entire series was helpful, informative to all of you. And I would like to thank all of you for joining the session. And thank you, sir, for your practical insights throughout the session and the series.
Thank you, Srilata. So this was a wonderful experience to deliberate on ESOP, which is one of the most contemporary and very important topics in current times.
Yes. To all the attendees and audience, stay updated as we come up with similar interesting sessions in our upcoming webinars. And if you want to know more, you can visit our website, subscribe to our newsletters, and read our blogs. And if you have any queries, please reach out to us via email to support@advaititech.in, or reach out to us through our website, or put your comments on our social media. We'll make sure that we'll reach you back. Once again, thank you, Anand.
Thank you so much.